A lot of retirees move to states like Florida, Texas, or Tennessee thinking they're making a smart financial decision. But what if I told you some of the most popular states are quietly costing retirees thousands every single year without them even realizing it? And even worse, some of the best states on paper actually end up being more expensive once you look at the full picture. In this video, I'm breaking down the 5 best and the 5 worst states for retirement income and the hidden costs that can completely flip your decision. Now, when people start thinking about where to retire, they usually zoom in on one thing. What's the income tax? They hear no state income tax and immediately assume that's the smartest move. Florida, Tennessee, Texas, Nevada, it sounds like a no-brainer. But here's the reality. States don't just decide to collect less money, they just collect it in different ways. If they're not taxing your income, they're likely making it up through property taxes, sales tax, insurance costs, or just a higher overall cost of living. And what ends up happening is retirees make a decision based on one variable while completely ignoring everything else. And over a 20 to 30 year retirement, that kind of mistake doesn't just cost you a little. It compounds into something much bigger than most people expect. Now, some states look great on the surface, but when you actually break down the numbers, they can quietly drain your retirement. So let's have a look at the 5 worst states to retire. Vermont is a perfect example of this. It's beautiful, peaceful, and checks a lot of lifestyle boxes. But financially, it's one of the toughest states for retirees, not surprisingly. Social Security gets taxed if your income is over $50,000 for single and only $65,000 for married couples. That's pretty low. Out-of-state pensions and retirement income from IRAs and 401ks are fully taxable at state rates. And when you do pass away, a flat 16% tax on your wealth significantly reduces what your heirs receive. Combine that with already high property taxes, and you're looking at a consistent drag on your income every single year. Now, Minnesota is another one that surprises people. It has great healthcare, that's for sure, which is a big plus, but it comes at a cost. Retirement income is taxed between 5.35% and 9.85% depending on how much of it that you have. IRA distributions? Yep. 401k distributions? Yes. Pension income? Yes. And Social Security is taxed if your adjusted gross income is above about $85,000 for individuals and $108,000 for joint filers. Minnesota also has an estate tax that can be between 13% and 16% if you have an estate over $3 million. So you're getting hit in a multitude of ways while you're living and potentially after you're gone. Now, California is more obvious. Most people would expect that, but California actually doesn't tax any Social Security. That's a positive, but it taxes every other type of income at rates up to 13.3%. 401k distributions, pension income, IRA withdrawals, interest, and net rental income all count, and they're all taxed at high California rates. And once you factor in the high cost of housing and the insurance, it becomes one of the hardest places to sustain retirement long term. Now, moving back to the east side of the country, Connecticut shows up pretty often on unfriendly states for retirement, but that really depends on your personal situation. If you're married and your adjusted gross income is below $100,000, or you're single and your AGI is below $75,000, then your IRA, 401k, annuity, and pension income is generally not taxed. But if you're over those levels, it begins to be partially taxed. And if your AGI is above $150,000 for married couples in retirement or $100,000 for individuals, it is fully taxable at the state income rates. And for those of you in New Jersey, I'm talking to you, Angela, it might be one of the most quietly expensive states of all. New Jersey is ranked second in the country, only behind New York, according to the Tax Foundation for Tax Uncompetitiveness. Here's the positive. New Jersey does not tax Social Security benefits. Well, that's a win. But you are taxed on IRA and 401k withdrawals, all state and local pensions, and out-of-state or private pensions. And New Jersey has some of the highest state tax rates in the country. If you're single with taxable income over $40,000, or you're married and making $80,000, it's taxed at 5.5% and could go as high as 10.75% depending upon how much that you make. And if that wasn't enough, property taxes are some of the highest in the country. Add on to that a 6.6% sales tax, and combined with a high Northeast cost of living, that's quite a retirement cocktail. And if that wasn't enough for you, if you manage to have assets left over and pass on in New Jersey, it will allow the first $25,000 to go to heirs tax-free. Woohoo! The next $1 million is taxed at 11%. Above that, it goes as high as 16%. That's a lot to go directly to the state of New Jersey. Now, when you actually look at the full picture, there's a few states that stand out, and they might be unexpected. Iowa is one of the most overlooked options for retirement right now. They've made major changes to their tax system, and for retirees, it's extremely favorable. Starting in 2025, Iowa made retirement income tax-free for residents 55 and over and got rid of its inheritance tax. Iowa hasn't taxed Social Security income since 2014, so most, if not all, of your retirement income can be tax-free, which gives it a huge advantage from a pure income perspective. If you do have rental property income or interest income, that is taxed, but at a newly lowered 3.9% for tax years 2026 and later. Now, Nevada is another strong option because of its simplicity. No income tax, no estate tax, no inheritance tax, and property taxes that are the third lowest in the country. It's clean and straightforward financially, but the trade-off is healthcare access, which becomes more important as you age. It's tougher to find out in Nevada. Okay, Pennsylvania is the one almost nobody expects, and it has a state income tax, but that's if you're working. Pennsylvania doesn't tax retirement income. That means Social Security, pensions, and retirement account withdrawals from 401ks and IRAs are all tax-free at the state level. That's huge. And when compared to high-tax neighboring states, Maryland and New Jersey, it's no wonder Pennsylvania is gathering up large swaths of retirees new to the state. Like Iowa, they only tax income like net rental income, capital gains, dividends, and interest. And Tennessee looks great on paper, with no income tax, no estate tax, no inheritance tax, and very low property taxes. But the catch is the sales tax. It's one of the highest in the country at 9.6%, and it also taxes groceries at 4%. That's big. So in Tennessee, you might be winning on taxes, but giving it all back in your spending. If you're looking for even more clarity, that's what See the Forest Delete is for. This is where I go deeper, speak more directly, and focus on what actually matters without worrying about headlines, algorithms, or clickbait. At See the Forest Delete, you'll get access to members-only videos that aren't on the public channel. The Members Elite tier is just $9.99 a month. Hit the join button to enter. I'll see you on the other side. And now back to the video. And Florida, of course, is the most popular choice. It checks a lot of boxes with no income tax, no estate tax, no inheritance tax, and a strong retiree infrastructure. They have a 3% homestead cap on property tax increases. Most people know about Florida, and on a full analysis, it's the most financially favorable state to retire in. Now, the biggest mistake people make is chasing one headline number instead of understanding the full financial picture. They hear no income tax and make a decision based entirely on that without realizing how many other variables are involved. But that's just the start. Another major mistake is underestimating how much costs change over time. Things like insurance premiums, property taxes, and healthcare expenses, they don't stay flat. They tend to rise, and sometimes quite quickly. So what looks affordable today might not feel the same 10 or 15 years from now, especially if you're in a state where those costs are already elevated. People also tend to ignore how their lifestyle impacts their spending. For example, moving to a warm weather state might mean higher utility costs, higher insurance, or higher day-to-day spending simply because you're out and about and doing more. On the flip side, moving somewhere cheaper might come with trade-offs in convenience or access or quality of life that indirectly affects your expenses. Another mistake is not thinking long-term about healthcare. A state might look great financially, but if access to doctors, specialists, or hospitals is really limited, that can become a major issue later on. And that's not something that you want to figure out after you've already moved. And finally, one of the biggest mistakes is not running the actual numbers for your situation. Taking someone else's word for it, reading something in the newspaper, watching this YouTube video. Everyone's retirement looks different. Different income sources, different spending habits, different priorities. What works for someone else might not work for you at all. And without a clear breakdown, you're essentially guessing on one of the biggest financial decisions that you'll ever make. At the end of the day, this decision is a lot more personal than people think. It's not just about taxes and it's not just about cost. It's about how all of those factors come together to support the kind of life that you actually want to live. The real decision isn't about finding the best state, it's about finding the best fit for your specific situation. And that means looking at your income sources, your expected expenses, your long-term care needs, and your personal preferences all at the same time. It means understanding not just what things cost today, but looking at how they might change over the course of your retirement. The goal isn't just to minimize expenses, it's to create a setup where the money supports your lifestyle in a sustainable way over time. And when you approach it that way, the answer often becomes a lot clearer. And one of the biggest areas retirees misunderstand is how Social Security is actually taxed in retirement. Because depending on your income sources, a surprising amount of your benefit can become taxable without people realizing it. So if you want to understand exactly how that system works, watch this video right here.